Up until about a month ago, investors were pricing in quite a high probability of US recession, some suggesting as high as 50% chance of the US falling into recession at some point this year. ISM was sub 50, spreads were widening, and the yield curve was flattening, along with a host of other measures pushing the US economy and markets with it lower. What we're going to have a look at in this short video is investigate the scenarios where in fact the ISM has gone below 50 and subsequently risen. Looking at the chart in front of you, the shaded sections are the recessions. So since 1969, we've had 7 recessions, as you can see here. And during those periods, obviously the ISM, and I'm using the new orders component, has fallen well below 50 and continued to as low as 40 or indeed lower, 25. However, there have been 7 other occasions where it's actually dipped below 50. This is the new orders index, and these have occurred in 1984, 89. We'll have a look at these shortly, but you can see them there on the screen, where the ISM new orders has dipped below 50 but subsequently risen. So we're interested in just investigating what has happened to markets in those situations. Before I do that, just quickly look at what happened to the ISM new orders index itself. So I'm just looking at the index. We'll look at it in original terms. So the bold red line is the average. 0 is the point at which it troughed at sub 50 levels. And you can see over the 12-month period, the average ISM new orders index is pushed up to around about 56. Obviously, there was one exception, and that was the 1989 or the 1990-91 recession, where it tipped back down again, but on all other occasions. So that's on 1, 3, 4, 5 other occasions, we've had the index push up to between 54 and about 63 on the new orders index. So generally, we've seen some reasonable recovery in the US market or in the US economy. How have various asset classes performed? Well, let's look at, say, global equities will be the first one. I'll look at it in US dollar terms. We can see here, again, 0.0 being the trough sub 50 and then the subsequent recovery. So equity markets have done quite well. Once again, the exception is as you might expect, the downturn or the move into recession. If I just add most recent data there, you can see the black lines updated for the current episode. But the average increase in the equity market after 12 months has been around about 20%. And if we actually strip out 84, we see actually if we we'll strip out 89. In fact, that was the week reading. The market has increased on average by about 25%. So equities have generally done very well in this sort of phase where the ISM's trough sub 50 and subsequently not gone into recession and recovered. Looking at some other asset classes, Australian equities here likewise have done quite well. I've still got the 89 scenario stripped out. If we put that back in, you can see that drags the numbers down. But outside of that, equity markets have done very well. 10-year bond yields, let's express those in terms of basis points. And with the exception of the 84 experience, generally bond yields have risen. And I'll strip out the 84 experience on this occasion. So if we use that, we can see that bond yields, excluding the 84, have moved about 90 or so basis points higher over that initial 12-month period. Just a couple of other assets to look at. Global equities, emerging market equities, we should say. What have they done? They've actually done reasonably well, although not as well as on a couple of occasions, certainly in 89 and 95, and these were the renewed recession, but also 95 through to 97 we had poor commodity prices, and that was holding back EM. Commodity prices more generally have not done particularly well. The most recent performance that we've seen is, I guess, a bit of an exception, although that did happen in 95 briefly. But by and large, commodities haven't done that well, and that's the RBA Commodity Price Index in SDR terms. So where's the improvement come from? Well, if we look at, say, earnings growth, and this is trailing EPS, operating EPS in the US, you can see that generally earnings have also improved with the ISM readings in these sort of sub 50 troughs, but no recession. except for 84 and 89. So, but by and large, earnings have been quite positive. And finally, if we look at the actual valuations on, say, US equities, if we grab that here, look at that in original terms, actually yes, in original terms, a bit hard to tell here, but you can see here the current situation, November 15, PE up around about 17 times. It's only been higher at the starting point, if you like, only been higher in the 98 episode, where it went from 20 to as high as we know, 25 times about 1.5 to 2 years later. So the market is slightly more expensive this time around than the average when ISM's trough sub 50. So I guess in summary, all this sounds quite positive. Generally, the ISM, if it hasn't gone into recession, it's generally done quite well over the following 12 months. Earnings have generally followed. Bond yields have tended to rise, yet commodity prices have generally stayed low. However, and there is a however, and I think it's important to note that on each of these occasions, policy has actually been quite supportive. So just looking at, say, the Fed funds rate, um, and just to explain, so the dots here on this occasion are the troughs in the ISM, sub 50, but no recession. The shaded areas are the actual recession. So what you'll quickly observe is that policy was generally being cut during these periods of recovery from sub 50 levels. Certainly in the early 80s, quite considerable easing was going on, and clearly inflation was a factor behind that. The same occurred here. We had already started the easing cycle in 89. Obviously, as we ran into recession, they were easing further, but again in 94.5, the trough in the ISM was helped, I suppose, and the recovery, the subsequent recovery was helped by easing here in 98, 99, only modest easing in 2002, 2003, and then as we know, QE was really an issue. Obviously, policy rates were very low, but QE was also during 2011. So, in some sense, the analysis that shows that if you don't go into recession, the ISM has continued to rise, well, that's all very well, and it's been good for equities, but generally it's been helped along by a very helpful Fed or central bank policy. The same perhaps cannot be said on this occasion, where in fact it would appear that we are moving ever so modestly in the opposite direction. Thank you.